This is Invested in Climate with Jason Rissman. I see climate as the world's biggest, most diverse, most important movement in human history. Millions of people dedicate themselves every day to protecting the planet. This podcast shares conversations with advocates, entrepreneurs, investors, policy experts, and anyone else that can push our thinking about what's possible and what needs to happen to address climate change. If you have ideas for episodes or feedback, get in touch on LinkedIn. If you enjoy the show, please leave a rating on Apple or Spotify. I'm currently building a new venture. It's related to storytelling and how we engage all sorts of folks in meaningful climate action. If you have expertise in this area, big ideas, or examples of something that's really working, get in touch. Thanks for listening and for doing whatever it is you're doing to support climate progress. Okay, let's get started.
There's all these carbon risks which are really hard to quantify. And that's what we specialize in. So we do all that in-house. What it does is it provides us an independent review of the developers' numbers. So we think that if you're purchasing data sets in the market, they're usually not good enough for this specific part. So that's why we had to build it in-house.
Hey everyone, there's been a lot of news in recent years about the risks within carbon markets. Companies buying carbon credits to offset their emissions have struggled with the uncertainty that a carbon project might not reduce as much carbon as they project. A forest could burn or a technology could fail to work properly, and the project will underdeliver. And yet, hundreds of billions of dollars are spent on carbon credits, a figure that could grow well into the trillions. Bilal Hussein is targeting this uncertainty in the market by offering insurance through his company, Artio. Fun fact, Bilal actually saw the need for insurance while working at our recent guest, Solvera, a carbon market sourcing and diligence platform, when he realized that investors were asking for collateral that no one had. Artio enters early, before the first tree is planted, to help more carbon-reducing projects become viable. If you consider the size of the carbon market and the shortage of ways to insure new projects, the opportunity for Artio is quite significant. Bilal makes this complex space rather simple and easy to understand. We spoke about his background, the need for insurance, the risks different types of projects face, the growth he's anticipating, and much more. If you've long wondered about the risks of carbon projects, this conversation will shed some light on the space and one approach to unlocking its potential. Enjoy. Hello, Bilal. Welcome to Invested in Climate.
Hi, thanks for having me. How are you doing today?
Great. Excited for this conversation. Thank you for joining. Where are you dialing in from today?
I'm based in a little town called Woking, just outside of London. Do you know it?
I don't. Do you get sunshine this time of year?
We do. I've actually just redone my garden and put grass down, so I'm actually craving sunshine and water. It's looking pretty good. We just had a heat wave, and yeah, it's been pretty hot the last couple of weeks.
All right. Well, enjoy. Bilal, let's get started by getting to know you a bit. Will you tell us a bit about your background and how it led to focusing on climate?
Yeah, so I actually didn't start in climate. I did economics and finance, and I did a stint at Bloomberg for a couple of years, for about 3 and a bit years. I studied economics. I worked in the equities team, but soon realized that that's not something I enjoyed, and very quickly transitioned to the ESG team, which was quite exciting, to be honest. Got to build risk frameworks, got to give ESG ratings to oil and gas companies, which is always fun. But yeah, that's really what exposed me to the environmental kind of side of things. And soon, I think I spent a year doing that when I came across an article that mentioned a company called Solvera. So I ended up applying there and got a job there. But yeah, I think that was quite a fundamental part of my whole journey in this space. Joining Solvera, I joined quite early on. It was quite a small team and I joined, spent a couple of years there and learned quite a lot about carbon markets. And really, I think the job there was a little bit different, which I guess we can expand on a little bit later. But soon after that, I also spent a year doing some geospatial AI and risk assessments, which was, again, a little bit different, but very focused on carbon markets. And all of that experience really led us to Artio and carbon insurance.
Very cool. Well, I was definitely a mutual fan of Solvera. Shout outs for our recent episode in May with Alistair Fury, CEO of Solvera, which I thought was a fascinating conversation on the role of tech and data in carbon markets. And I guess that role at Solvera was formative for you and really helped you understand the problems in the carbon markets. Let's talk about your company, Artio. What is Artio and what are the problems you're trying to solve?
Yes, that's for sure in terms of the time I spent there. I want to focus a little bit on what we learned there and what the kind of organic transition to Artio was. So at Solvera, the biggest job at that time for the market was there was a lot of credits in the market that just weren't doing what they said they did. So there's a lot of low integrity credits in the market. So we spent about 2 years cleaning that. And that was a big job. But more and more as I worked there, I realized that the market was moving towards early stage and people were trying to finance their own deals. And that's really why I joined the next company I joined called Maya Climate. So Maya used to specialize in connecting buyers and developers and encourage transactions, help with transactions, and super early stage. I used to be in charge of doing the due diligence on all these deals as a single person. So I learned quite a lot in that role. But the biggest thing I took away was investors and buyers kept asking for collateral, which just wasn't available. Buyers couldn't give collateral. Developers couldn't give collateral. The reason is if you look at an afforestation project, a lot of the time the developer might not even own the land. It might be community lands, it might be government land, it might be leased. And that's usually what happens in these deals. That's put up for collateral. So that's really where Artio started. I saw a space where these transactions needed some financial support or some security or collateral, and that's what we provide. So Artio is carbon insurance, and we specialize in early stage insurance. So when we say early stage, we mean before the first tree is planted. We would ensure the delivery of carbon credits or the loan. And I can quickly just touch on what those two mean. So if you have a big corporate, they might do a pre-purchase. What that really means is they might pay in advance of the credits being delivered. So the credits might be delivered in 5 years, but they might invest today. There's a risk there, obviously, right? Like there could be a fire, there could be a flood, there could be fraud. That's really why insurance does. It guarantees that delivery. And if they don't get what they bought, we come in and we pay them either cash or we can source credits for them as well and settle in credits. But more and more we realize that that kind of trend is still strong, but there's an institutional capital coming in, and that's not how they work. And that's where our second product works, which is non-payment insurance. What that means is if there's a corporate again who wants to invest in a project, what they might do is they might pay on delivery instead of paying upfront. Very common in other markets, right? And you can't expect corporates to keep paying upfront for something that might be delivered in 5 years. But what happens is there's a funding gap now. The developer still needs money to make the project. The corporate pays on delivery, so who funds them? That's really where a bank comes in. A bank would give them a loan facility or debt facility. The banks require insurance to do that effectively and at scale. And that's where we come in. So we provide non-payment insurance to say, hey, if you don't make your money back, we will come in and settle that shortfall for you. Both these things are designed to just encourage transactions in the early stage by offering a collateral or a guarantee, in other words.
Help us understand the impact of what you're doing, both from the financial as well as the climate side. In other words, can you quantify the market size and impact potential of Artio, and how big of a problem is it?
Yeah, it's a great question. I think the market for Artio is as big as climate markets can get. The reason is that there's no other industry where you think, take property, commodities, all these markets have insurance. So the bigger these markets get, the bigger our market size gets as well. A good example is carbon markets. Carbon markets, people throw these figures around like $50 billion market, $100 billion market. Number one, we think it can't get there without insurance because you need some stabilizing force in the market. And secondly, insurance gets you there as well. It's not going to organically get there. Insurance provides that security for you to invest with ease and at scale. So that's for the carbon markets. We think the same in other climate risks, fire, flood, drought. You're seeing more and more of these. We've just had fires in Scotland, which is where I actually went to school in Glasgow. So that's at home. And we're also seeing a lot of droughts and floods in Pakistan, which is where I grew up. So it hits home to me. But these are the kind of problems we're trying to solve. If we can't offer insurance on carbon market, or if we want to expand outside of carbon markets, we will be looking at these markets as well to see, can we utilize the same risk model that we have? Because that's what we are. We specialize in data and risk modeling. Can we utilize the same risk model to look at these markets and somehow mitigate the risk there and help people become more resilient and more adaptive?
Bilal, you say that the market size is as big as the market itself. Say more.
Exactly. Because the whole point is insurance. The way you calculate insurance market value is you add a penetration number on these things. So normally insurance can be 10% of the total market value. That's a really good market for insurance. It can be lower as well. It can be up to 5%. But if you have $100 billion carbon markets, your insurance market can be 5 or 10 billion. Eventually, obviously, you as an insurer, you can't do the whole market because you have limitations in how much capacity you can put in different regions. So you do share with other insurers, but really that's the market size. So I always use that number when looking at like the wider market.
Yeah. And do you have any sense of how much capital or how many organizations, companies are holding back and not participating because the lack of collateral or just the early stage risk?
We think a high amount, especially in the debt facility space, in the bank's institutional capital space. The reason is that banks work for their clients. Clients they aren't as comfortable because of the last couple of years. These clients can be corporates, these clients can be private individuals, but they're less comfortable with the space. So what makes you more comfortable? Right? It's usually insurance that makes you more comfortable with the risk. So for sure, I completely agree with that. We're also seeing corporates trying to become more active in this space. So recently, I believe Wise committed an amount of money to purchase carbon credits. You obviously have your original kind of players like Microsoft, your Googles. But in the UK recently, a construction company or like another company called Arup, they did it. They're smaller players. That's where we see the future of the market is smaller SMBs, medium-sized enterprises, these coming in and then also participating. And we think insurance can help them do that.
And you focus at the early stage. Tell us about the different phases and how risk changes for those that are investing in carbon products.
That's a really good question because sometimes people get confused on what we mean by early stage. I'd love to clarify that as well. So when we say early stage, we mean the project has not started yet. They're just a design or feasibility study on a piece of paper. So the risks there are completely different from the risk of a project that is at the PDD stage. PDD, in other words, are design documents. It's ready to go. It's already done 3 years of work, most likely. So the risks in the early stage usually mean there's a lot of carbon modeling risk. So there's a lack of data in general on how trees grow, for example. When you look at biochar, there's a lack of data on how does the machine work in this region with this feedstock, right? So there's all these carbon risks which are really hard to quantify. And that's what we specialize in. So we do all that in-house. What it does is it provides us an independent review of the developer's numbers. So we think that if you're purchasing data sets in the market, they're usually not good enough for this specific part. So that's why we had to build it in-house. The second part is a big financial risk. A lot of these projects, they're not financial experts. They're project experts in terms of delivering on growing a forest or creating partnerships with biochar farmers and all these. But they're not your CFOs. That's not the kind of personality you get in these markets. So what tends to happen is we have to do a lot of financial analysis in-house to make sure the project doesn't run out of money before they deliver credits. So we do a lot of cash flow analysis, we do sensitivity analysis, we do a lot of these. So that's for the early stage part. As a project moves to kind of PDD and execution phase, what you get is a higher project governance risk. Governance for us basically means if you had a plan to plant 1 hectare and then the next year plant 1,000 hectares, that's a big scale up. How are you going to execute on that? Usually what that means is they'll buy land or they'll sign lease agreements. And that's a different operational complexity. So we call it kind of project operational complexity or governance risk. And that tends to go higher. That's quite a qualitative analysis that we do there because you have to get in the fields of the project and what they're trying to accomplish rather than looking at pure numbers. You have to also develop a relationship with the developer there. The last thing I'll touch is mature projects. There's a much higher risk of natural catastrophes. So when you have fire, flood, drought, storms, it's much harder to replace those trees. Or if a tree is 10 years old and it catches fire, it's going to take 10 years to grow again, or maybe 5 years because of some healthier environments. But it's hard to replace those. Whereas if it happens in the first year, you can just replant realistically. So that's how the profile of afforestation projects work. I chose that as an example because it's easier to understand. Biochar has different problems, but I hope that makes sense for afforestation.
Let's talk about the different projects. Are you able to offer insurance across different types of carbon projects?
We are able to offer more than afforestation. So we can do biochar as well. And we're adding enhanced rock weathering and possibly improved forest management in the next 2-3 months. Our whole way of working is that we specialize in project types and then release a fully comprehensive policy. When we first entered the market, we saw something that we thought was a blocker to scaling the market. That was that current policies were you had to purchase 2 or 3 policies to really get full coverage. And that, I think, was not good enough because developers, buyers, this is a new market for them. You don't want to go in the market and say, I need to purchase this policy from this insurer, another one from this insurer. So what we've done is created a fully comprehensive policy that covers pretty much all risks in afforestation and biochar. The way we did that was we looked at the last 20 years of project history and looked at why they underdelivered. And that's what we covered pretty much. So yeah, we try and specialize in these project types and then launch a kind of coverage for that project type. But we are also market driven, right? At the end of the day, whatever the market wants insurance on, that's what we provide. So we do rely significantly on buyers coming to us and banks coming to us telling us, this is where we want to deploy capital. Can you give us insurance? We work on that to release that coverage.
Well, that probably gives you a really unique perspective on how risk varies across different types of carbon projects. And I'd love to learn about that as for the things that you just mentioned in terms of forest management or biochar or afforestation. What are the different risks and what do you consider most risky, least risky? How do you characterize them?
It's a great question because I was actually at a conference last week for Asia Climate Summit, and I was asked the same question about what are risks that an insurance company can't cover, and this kind of touches on that as well. So when we look at afforestation, we have your natural catastrophes, carbon, financial, project governance, political, all of these risks. They're quite understandable, and people understand them quite well. Like if I tell you, hey, if a fire happens, the tree burns down, you get that. So it's quite easy to understand the afforestation risks. It gets a bit trickier when you move to other project types. So for biochar, for example, we have to cover technology risk. This means that if you buy a machine for biochar and it performs worse than you expected, we have to provide coverage for that because the buyer doesn't care if it performs worse. They just want the credits. So that's what we have to add to our risk models. The same thing with enhanced rock weathering. We have to start adding soil analysis in these risk models. So what we're seeing is, I would say like 80% of the risk modeling is the same. If the project governance is still the same, right? Like you have to expand, you have to purchase things, the financial, that's still the same. But what differs is usually the carbon element, how carbon grows, and then technology piece. Luckily, afforestation, the technology is millions of years old or whatever. So everyone understands the technology of trees, but it's much harder to quantify the technology risk of, for example, direct air capture, biochar. So then that's what we have to start adding. And that's really the main thing that differs across these. And that's what we try and cover because that's really what they want coverage for.
Really interesting. And, in some ways, I think of what you're doing is helping this market mature, is that there's been a lot of characterization of the carbon market as being a wild west of uncertainty. And as you said, there's a lot of problems with less credible projects. And I think your product is offering a way to help the market mature and offer more investor confidence. Leads to the question of how's it going? The company's been around for about 1.5 years. I'd be curious the traction that you've seen and the feedback that you're getting.
It has been 1 year and a bit since we started working on this full time. And we launched our product about 2.5, 3 months ago. Insurance is a difficult product to launch. You have regulations. We can't offer insurance from our balance sheet because we're very early stage company. So we have to partner with insurance providers. And I can touch a bit on that, what that means. But we were able to get our product out to market in one of the fastest insurance product launches in Lloyd's. That was, I think, quite a significant achievement by us. And that's really, and we did all of that in-house, which is quite important to say. So we don't purchase data sets. We do all the modeling in-house. We did all the policy wording in-house. All of these things where people told us that you might have to hire an actuary. You're looking at the chief actuary here. So a lot of things that people said to us you'd have to hire, we kind of took down as a challenge because I think in the current space in early stage climate tech companies, we're seeing quite a lot of high valuations and people hiring more and more people without justification. And we didn't want to make that mistake. So we stayed quite lean. There's 3 of us and a non-exec director in the US. We did all of that in-house and we managed to launch that product. We had quite a lot of interest from insurers to launch our product. That's something that, again, there was a bit of doubt in the market where insurance companies come in. We actually saw the opposite. We were very transparent with our insurance companies. We did workshops for 6 hours where everyone was sweaty by the end of the workshop. We managed to get our point across that this is really how you model the risk. So if you trust us, this is what we need from you. And we were able to get quite a large risk line and capacity from them. So that's the product launched a couple of months ago. Now what we're actively doing is issuing quotations on projects. So these are quite long sales cycles, you can call them, because really working with the board decision-making and the CFO decision-making with all these corporates. So what we do is we issue the quotation and then we wait. We wait for the corporates to make their decision. Same thing with the bank. We issue the quotation and the bank makes their decision. But one thing that we also wanted to do from the very start was we never really wanted to sell risk services to developers, because that's, again, something we saw as a blocker to the market because they don't have money, right? So what we do is we give them a free insurability assessment. This is completely free. People tend to not believe me when I say that because people are still quite suspicious of the word free in carbon markets, but I promise you it's completely free. And what that does is they can come to us before they go capital raising. And we look at their project and tell them, hey, we are happy to insure your project when an investor invests in you or a bank gives you a loan. And that gives them a form of leverage when they go to market, right? And Artio believes in me. We've seen that be quite successful. The developers take that out to market for us. And it's a good go-to-market strategy for us, right? So developers go to buyers and tell them about us, and the buyer comes to us. We already know the developer by that point, so we're comfortable with the project. But yeah, that's the two things we're focusing on right now is insurability assessments for developers, and secondly, actively issuing quotations on current transactions.
Bilal, you mentioned using workshops as a way to raise awareness or sort of drive an understanding of this. Walk us through that. What did those workshops include, and how did they shift thinking or push thinking in a way that was helpful?
The aim of the workshop is really to try and show that we understand the risk. So there's multiple ways to do that. We create case studies quite effectively. So we would say, this is a project we looked at. Here's a 30-page piece of analysis. Let's go through it bit by bit. So we would go through all the different natural catastrophe risks, the carbon risks, tell them what we do differently than the market. That's quite an important piece for them because insurers love to have a moat, right? They love to have something that others don't have. So that's what we have to show them. This is how we do it. This is how the market does it. So a lot of the workshop is focused on that. But the second thing is insurance companies, the way they work is they have to create a portfolio, then predict a portfolio of insured transactions. And then they assess, if we did, this is what our exposure would be in the market. This is what our liabilities would be in the market. And we had to do that, but there is no data in the market on these things. There is no insurance before, right? There is no claims. So how do you do that? So that's what we had to kind of be creative about and say, here's all the historical projects. This is what we would have done on these projects. This is how we would have analyzed the risk. If we had insured these projects, this is what the outcome would look like. And that takes a lot of work, but that really made them comfortable with that because we can say, if someone who doesn't have our risk model insures this transaction, I think based on our analysis, there was a higher likelihood of a claim than not. So more than half the projects underdelivered. So how do we fix that? That's the point we have to get across is we wouldn't insure this project. We only insure the other ones. And for the ones where we think they will underdeliver, we work with them with an insurability assessment to say, hey, can you bring this down a little bit? So I think the workshops were super focused on data transparency and working with them as partners rather than us telling them, you guys don't know anything, because there are information gaps. We were insurance experts when we started. I would say we've learned a lot in the last 6 months, but that was a journey and that was working with them on this product.
Let's play out how your coverage actually helps someone in the case of a loss or in case that there's a legitimate claim. And so, for instance, I'm a big company and I invest in a afforestation project, and then there's a catastrophic wildfire. The forest goes away. If the project was insured, what happens?
Okay, so if a corporate did a pre-purchase, let's say in the simplest example, and they expect 1,000 credits in 3 years' time, there's a number of risks. There's a number of things that can go wrong. 3 years ahead of time means that when it comes to project delivery, the registry, like a Vera, could reject them. So that's something that we would cover. We would recheck the documents to make sure that they are of good standard. There could be a fire, like you mentioned. The trees could grow lower or less fast, as lower than they expected. The project could run out of money. All these things could happen. But let's say there was a fire and it took out a portion of the land. So instead of 1,000 credits, the project gets 900 credits. So when we would have signed the policy with them, we would have asked this corporate, do you want the policies to be settled in cash or credits? Sometimes it might be cash for corporates. The reason is that if you have a big sustainability team, you can probably source your own credits. So you might just want the cash, right? You trust your own work than you our work. But if you're a small team, maybe like let's just give an example, like a co-op or a Tesco, maybe you don't have 100 people on your sustainability team. You would probably want the credits so you can just use them for your climate targets. If they had set credits, we would have defined in the policy what kind of credits they want. We do ask corporates to take a step back. Don't be super specific. It's a very supply constrained market. You can't say that if we're insuring a project in Ghana, they can't have a replacement in Ghana with the same characteristic. There's probably only one or two projects like that. So they need to take a step back a little bit and say, maybe I'm happy to accept neighboring countries, bordering countries with the same plantation or same forestry characteristics. If they had defined that, we would go to our supplier pool and source those credits for them and settle in those credits. So we have, like I mentioned earlier, we have the insurability assessments. What that does is it gives us a supplier pool. It gives us credits that we're comfortable with. We would just go to them a year ahead of time because we can monitor under delivery with our biomass models. And we can say, we think next year there's going to be 100 credits under delivered. Let's go to our supplier pool, purchase 100 credits according to the characteristics that they've selected and settle with them. In the case that they want cash, we would have defined the pricing within the policy as well. So they would know if the under delivery happens in 2025, this is how much I would get paid. So they can also plan in advance if that happens. So those are two scenarios, and that's how really it would work.
Well, that flexibility between receiving cash or receiving credits, I imagine, is really attractive. And I think for many, it's going to come down to pricing, right? Is that ultimately there's a lot of companies or banks that feel pressure to invest in the carbon market, which at times is riskier than they would like it to be. And so you're offering seemingly a really good way to limit that risk. But of course, it comes with a premium. What is that premium? How much of an increase upon a normal carbon market project would it cost to insure it?
It's the same price for both things. The reason is that even if we go for the credits case, there's a chance that we might have to fall back on the cash because of the constrained supply, right? So it's actually they're both the same options. People do have the misconception in the market that insurance is very expensive. It's not, I can tell you, and I can give you a case study of why I say that. When the corporate does a pre-purchase, they normally get a 20 to 30% discount on the spot market of that year. Because they're coming in early, right? They're putting money in it and start. Because of that, insurance would never be above that. Insurance, the maximum I think I've seen in the market is probably 10% of the cost of the credits. So if you're buying a credit for $15, you might be paying insurance for $16.50, or like in total it'll be $16.50 after the insurance price, which is quite cheap, I would say. But that's the high end. Most of the deals that we see sit between 3 and 5% overall, which is super cheap, I would say, for someone who has a climate target and they need to meet them. So I think that's something that we're trying to do a little mythbuster exercise there with people to say it's not as expensive as you think. The reason is that insurers do specialize in risk management. So we are able to look at our portfolio and see where the risks are and manage that much more effectively. So we don't think insurance should be a blocker to investments.
So you have an enormous market opportunity and a product that limits risk for anyone that's entering it. It's also a very crowded market. And one of the hardest things for anyone in this space is just navigating all the many different players. How do you hope to stand out, and what sort of growth are you hoping to reach over the next few years?
We want to be the earliest insurer in the market. That's our niche, and that's what we want to specialize in. Insurance is not so much of a crowded market as other maybe marketplace. So there's a lot of geospatial players. There's a few rating agencies, not that many, but there's a lot of contractors that do similar work now with risk assessment, due diligence. I would say that it's a market of contractors. Honestly, there's a lot of individuals offering the service. With insurance, it's less crowded. I think there's 3 or 4 insurance specialists for carbon, and then there's a generalist. It does mean that when it comes to us, because we try and be vertical and less horizontal, meaning that we try and specialize in project types, we tend to be cheaper because we've modeled the risk much more effectively. So we are much more careful in what projects we choose. But with the ones we choose, we're usually cheaper, and we're usually much faster with giving a quotation back. We're a lean team, but it's a world of automations. So we have automated a significant chunk of our underwriting. And we utilize that so we can analyze projects super fast. We can give that feedback. So what we really want to be known as in the market is the earliest insurer, one of the cheaper options, also someone who works for developers and helps make better projects, because that's something I think we just as a market need to do much more of. I think the hardest thing to do in this market is create a carbon project, is to be a developer. It's often kind of forgotten about the difficulties. So we want to be known as the insurance company that helps them make that project.
Bilal, you obviously came with a bunch of domain expertise, having worked in this space for a couple of different companies. What are some surprises that you've learned about the carbon markets since working on Artio?
It was surprising to see how many people would disagree with your solutions. I think I always say this to people that we hire or we worked with, to say, just be ready for an emotional market. Other markets aren't this emotional. If you launch a really good product, people will love it usually, right? Either they love it or they'll ignore it. Carbon markets are different. Even if it's an amazing product, there will be people who disagree with it. So I think that's just something that you have to bear in mind when working in this market. There will always be people philosophically who don't agree with this market, which is fine. You just have to kind of take that on if you work in this market. The other thing is I've realized the foundational impact of policy. Policy is ever more important in this market because everyone keeps talking about the lack of demand. Demand only really comes with increased policy. Voluntary markets, I think that they've proved to be a good pilot and a case study, but really policy should bring them into more structured markets. And we are seeing that just a bit slower than we expected, I think. So hopefully in the next couple of years, we see a lot more integration. Asia, APAC, they're taking the lead on this, I would say. The EU is kind of slowly behind that as well. Obviously, we have US where it's a bit slower than probably what everyone wanted it to be. So I would say that that's something that I've learned to appreciate a lot more is policymakers, how to work with them, how to give them the information they need to make better policy decisions, and all of that kind of transparency with policymakers. And the last thing I'd touch on is this is something that I think as a market we need to work on. It's something I've learned that the market struggles with is it's really hard to finance smaller deals. And that is a problem to scaling. I think everyone likes to talk about these big deals like $50 million deal, $100 million, Microsoft invested in this. But that doesn't really scale the market. That should be an outlier, if anything. You should have a lot more $10 million transactions, 15, 20, $5 million transactions. And we're not seeing enough of those. And the reason is that banks can't justify the IRR internally for those smaller deals. Corporates are doing less pre-purchase and more offtake. So who really funds these projects? And that's something we want to work on figuring out is how do we kind of help structure those deals much better at smaller ones. We can look at portfolio views, we can look at syndication, all of these kind of things. But that's something I've learned. I think that's something that we want to help fix.
Bilal, I'd love to hear your thoughts on data and transparent risk assessment, which is, of course, fundamental for Artio, but perhaps also key for other climate domains. Are you seeing a role for better data and transparency to help accelerate progress in other climate areas?
I think so. I think the climate risk aspect has become so important in the last couple of years. I was in the US for San Francisco Climate Week, and I would say 50% of the events were talking about fire. And it's because it's so relevant to them. When I go to Pakistan, I see the same kind of topic. It's not fire, but it's drought, it's floods. And I think risk assessments need to change a little bit. They need to focus, I would say, 80% on mitigation now and 20% on the assessment. They need to become much more proactive in this. That's something that we say to insurance companies that we try and do as well. It's now less about providing insurance, but it's providing insurance and also helping mitigate that risk, which is in our interest. A good example is cyber. Cyber, they've become really good at it now. The good cyber insurers now don't only provide insurance policies, but they do like monthly checks. They do all of these kind of mitigation efforts. And that's something that we want to take on as well with when we provide our insurability assessments, we give them so much feedback for free. For example, one of the projects we looked at, we told them that the way they're planting the trees in the US is creating a wind tunnel, which means the storms are going to just wreck those trees when it comes. And it's much better to a different pattern or choose species that are more storm resistant in that specific region. So I think that's something that we can do much more of is focus on risk mitigation for these risks rather than just assessing and kind of stepping back. And the last thing I touch on is political risk. Political risk, insurance industry is a specialist in this, right? Political risk has been around for so long. And I think in a lot of these climate risks, political risk is playing a much bigger part. So when you give fire risk insurance, you can't just look at the fire risk. You have to look at the political risk. The reason is that if the person on the ground, the operator, relies on government funding to execute, there's a big risk there, especially in the US, for example, right? We're seeing the same in Europe. In Europe, if you have drought, what the government's view on drought mitigation? You have to take that into account. So we're seeing political risk play a much bigger part. The problem with that is political risk insurance is super cheap, generally speaking. And that's a problem because now it's becoming a lot more unstable and insurance companies hold all the losses while equity investors hold all the upside. So I think that's something we're seeing is how a lot of people are talking now about equitable risk sharing. So when we look at these risk assessments, we've identified the risk. We need equitable risk sharing here. We can't just be like, if there's loss, insurance pays the whole thing, because that's not sustainable. If you're insuring wildfires in LA, realistically, an insurer's not going to do that. But what they could do is create syndicates there that can distribute the risk, or they could have a bunch of different financial structures where insurance is part of the risk. So I think that's something that we're seeing in other climate parts, is how do you assess or mitigate those risks and syndicate that risk?
Yeah, I'd be curious, are you seeing other use cases for insurance to help manage risks of the climate transition?
So in carbon specifically, I can touch on buffer pools. It's a common topic. The buffer pools, currently the registries own it. It's a carbon risk, but really it's a climate risk, because most of the risks in registries is for natural catastrophes. So we're seeing insurance. We think insurers will play a bigger part in managing that.
You should definitely define a buffer pool. Probably not something everyone knows.
Yeah. So buffer pool is a bunch of credits put aside when the project developer issues the credits. So for example, if you generate 100, the registry will say, it's like a tax. The registry would say, hey, you generate 100, your fire risk is a little bit high. We're going to keep 10% just in case of the fire, and you can sell 90. What's happened is over time, these buffer pools have become really saturated. There's all kinds of projects in there. The fire risk is really confusing because all these projects have different fire risks. So the question now is, who manages that? Should it be a registry who really aren't experts in that field? They've had to create it out of necessity. So we're seeing insurance kind of come in there and looking at, how do we manage this? Should we take this on completely? Should we just manage it? That's not something that we could fully focus on currently because we're still watching it. But I think it might be interesting in the next couple of years. And then the other risks, I think, in terms of managing the risk, I've already mentioned like proxy reference to cyber, how that's worked. But flood insurance I think is super interesting. The way the flood is modeled is you predict the likelihood of a flood happening every year, but you look at it over 100 years. So there's a 100-year return period, which means that over a 100-year return period, you could have a flood that's 7% devastating. It could have it happen every year. Traditionally, what used to happen was, because the number is low, you would be like, it's not that big a deal. It won't happen this year, right? It might happen next year. Or it might only happen once in 5 years, something like that, because the number is low and it's done over 100 years. The Valencia floods are a good example of this. That's really where, when we modeled it, we predicted that it should have been much better handled before it happened, because that number was a little bit high. It wasn't too high, but the other characteristics of the environment, like your rainfall, your temperature, your humidity, your wind patterns, all of them kind of indicate that it can happen every year. But worse than that, it can happen multiple times the next couple of years. So I think the takeaway here is that even if the number is 5%, which is a low number, I think the losses would be so much greater than the mitigation. So it's much better to just be prepared for these things. Put your flood defenses up, have an evacuation plan for your residents, all of these things. And I think we should stop focusing so much on it might happen once every 100 years and look at, if it happens, what should we be doing and what can we do today to minimize the losses? And insurance, I think, should enforce that instead of recommending it. So you can't provide insurance if they don't do X, Y, Z. So I think that's the change of tone that we're looking at as well.
Tell us what's ahead for Artio. What will the next couple of years look like, and what are you excited about, and what's keeping you up at night?
We want to add much more coverage to our product. Like I said, we're a lean team. There's only 3 of us. We do try and specialize as much as we can, but we want to add much more project coverage. Enhanced rock weathering is going to be an exciting one. Improved forest management will be another one. We're waiting to see what Red Plus looks like. Red Plus, for people who don't know, is credits you get for conservation of forests or reducing deforestation. It's a bit of a controversial project type, but that's something I personally love, especially because they do need carbon financing. So I think that's something that we're watching, and Artio will be looking at being more active in that space probably from next year onwards. We want to scale the market with more institutional capital. We want to get more debt providers in. We've spoken to a lot of banks that are interested. So we're trying to show them that they can use us for due diligence as well, not just for insurance. They can look at what we've done with the project to help them deploy that capital and make the arguments internally, because they do have to sell this internally. And then the last thing I think we want to look at is, how do we support developers? How do we create these projects? A good example is Corsia Insurance. Corsia, for people who don't know, is a carbon offsetting scheme for aviation, for airlines. But in order for them to qualify for those credits, they need to have basically political risk insurance from us. Because how do we do that much more effectively? Because one thing that when I speak to people, especially in the carbon markets, is there's this misconception that insurance capital can come like this, like a flick of a switch, but that's not how it works. We do need to work with our insurance partners to convince them that this is how we look at it, and it takes a bit of time. If there's a compliance market requirement, we need to be told in advance that this is coming. So that's something that we want to work on, because that really helps developers get their products out to market. And we want to look at the ways to support the early stage part. Can we provide much better insights? Can we provide much better mitigation efforts? And really, how do we also not just think of carbon, but look at climate in general for project developers? Project developers can be forestry experts in general, not focusing on carbon markets. They can be drought operators. How do we help them? So these kind of coverages we're also looking at. We might not provide insurance for them, but we might look at risk mitigation efforts for them.
Bilal, thank you so much. I learned a lot from this conversation, and definitely wishing you all the best of luck.
Thank you very much. Thank you for having me.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.